With the financial waters feeling a bit choppy lately, the question on a lot of your minds, and frankly mine too, is where to park your capital when the risk-on party seems to be winding down.
Right. It's a tricky environment.
So for this deep dive, we're zeroing in on a recent Macro Butler newsletter. It's got a rather direct title. When risk off means rock on. Bitcoin cries, gold shines.
Exactly. And this newsletter, it offers a pretty strong perspective, doesn't it, on the contrasting fortunes of Bitcoin and gold right now.
Yeah, it really does.
So our goal today is to really, dissect their arguments and try to understand why gold is currently getting all the attention while Bitcoin seems to be, well, facing some headwinds.
And what that might mean for listeners for how you might be thinking about your investments.
Precisely.
Okay, let's unpack this right away then. The newsletter hits the ground running. It observes that Bitcoin actually reached its peak shortly after the inauguration and has been kind of on a downward trend ever since.
Yeah, and it wasn't just Bitcoin. They also point out Ether, often seen as number two. It's seen a really significant drop, too, nearly 50% since the start of the year, they say.
Wow, 50%. You might be wondering, given that initial surge, what factors could have triggered this reversal in sentiment so quickly?
Well, what's fascinating here, and what the newsletter really focuses on, is the stark contrast with physical silver and particularly gold.
Right.
While these digital assets have been struggling, the newsletter highlights that these, tangible commodities have been quietly accumulating single to double-digit gains. Quietly gaining.
It really makes you reconsider that narrative we've heard for so long about Bitcoin being this ultimate, unshakable store of value, doesn't it?
Absolutely. The newsletter directly calls that into question. Now, shifting gears just a bit, they introduce a pretty compelling historical analogy, trying to explain Bitcoin's initial appeal, maybe. They call it the new oil theory.
Ah, yes, the 47th president's campaign comment, comparing Bitcoin to oil. Exactly. And for those who remember the 70s, the newsletter draws a parallel to how oil prices were, well, possibly intentionally inflated back then.
Right, and if we connect this to the bigger picture, the newsletter suggests something quite provocative, like those inflated oil prices helped alleviate the U.S.'s debt burden in the 70s. Maybe Bitcoin is serving a similar function today.
So presented as this booming asset, maybe inflated to soak up some of that huge U.S. debt.
That's the idea they're floating.
Okay, here's where the newsletter takes a really interesting, maybe controversial turn. It throws out this idea of Bitcoin as a potential Trojan horse.
Go on.
Well, think about it. It's marketed as this decentralized anti-establishment thing, right?
Yeah.
But could it actually be a tool for central banks?
Okay, how so?
The newsletter proposes this idea, maybe a bit out there, that Bitcoin could be a gateway, drawing people into UST-backed stablecoins.
Which aren't CBDCs directly, but they operate within the existing system.
Exactly. Often seen as maybe a stepping stone towards fully government-controlled central bank digital currencies. What do you make of that kind of a, well, curveball?
It certainly raises a big question about who really benefits, doesn't it? The newsletter doesn't mince words here. It suggests Bitcoin investors might unknowingly be part of the machine.
Oof. That's a challenging perspective.
It really is. Makes you think twice about that whole narrative of Bitcoin as this totally independent force.
And to really underscore the wildly different opinions swirling around this, the newsletter mentions Larry Fink, how he apparently went from Bitcoin skeptic to seeing its potential.
Right, that shit.
And then you've got Michael Saylor, who, according to the newsletter, is supposedly advising the U.S. president to sell the gold at Fort Knox to buy Bitcoin.
Wow. Yeah, the newsletter definitely frames that as potentially part of a significant meme scam.
It just highlights how polarized the views are. It's incredible.
That anecdote really brings the, let's say, speculative fervor into sharp focus. But, okay, let's move past the hype for a second and look at the data they present. Bitcoin's actual behavior tells a somewhat different story.
How so?
Well, the newsletter points to its strong positive correlation with risky assets, often above 0.5 with TQQQ. That's the triple leveraged NASDAQ 100 ETF for anyone unfamiliar.
Okay, so it's moving very much in tandem with, like, high-growth tech stocks.
Pretty much, yeah. So it's not behaving like that uncorrelated safe haven we sometimes hear about.
Right. Instead, it's largely been tracking right alongside other investments that, carry higher risk, but also maybe higher reward potential.
Exactly. And if we compare the drawdowns from their all-time highs, The S&P 500 and Bitcoin have had considerable corrections, but gold, notably, has continued its upward path, hitting new all-time highs.
That divergence is quite telling, isn't it?
It really is. And what's also noteworthy, according to the newsletter, is the increasing correlation between Bitcoin and the S&P 500, while gold's correlation with the broader equity market has actually been decreasing.
Interesting. So if the S&P 500 were to, say, revisit its Q1 2022 peak, the potential downside for Bitcoin from where it is now looks significantly larger.
Yeah, the newsletter suggests around a potential 40% drop for Bitcoin in that scenario compared to a more moderate pullback they estimate for the S&P. That's a pretty significant difference in potential risks.
Okay, 40%. Got it.
Now let's delve into the Bitcoin to gold ratio. This is another key point for them.
Right. How many ounces of gold one Bitcoin buys?
Exactly. And the newsletter emphasizes it's currently at a very elevated level near 26 times. Compare that to its low point in 2019, below 3 times. And there's that historical kind of pivot point around 10 times since 2017.
So 26x is high, suggesting Bitcoin is relatively expensive compared to gold right now.
That's the interpretation. And what's particularly interesting is how peaks in this Bitcoin to gold ratio seem to coincide with peaks in another ratio, the S&P 500 to oil ratio.
Huh. Okay, how do they connect those?
Well, the newsletter uses their 7-year moving averages to show how those peaks often come just before breaks below the moving average. They suggest this might be an indicator of a broader correction brewing in risk assets.
It's like these different ratios are maybe flashing similar warning signals around the same time.
That's the argument they're making. However, it's important to note they also mention their analysis didn't find a really clear correlation between the Bitcoin to gold ratio and the gold to bond ratio when it comes to predicting, say, inflationary versus deflationary shifts over the last decade.
Okay, so it's not like a perfect crystal ball for everything.
No, definitely not. But they do highlight the S&P 500 to gold ratio as pretty significant. They call it a potential canary in the financial coal mine for that S&P 500 to oil ratio.
And the peaks and troughs in Bitcoin to gold tend to mirror the S&P 500 to gold.
Apparently so, according to their charts. It's like one might be giving us clues about the other. And then to really hammer home the speculative nature they see in Bitcoin, they make this rather striking comparison. The Bitcoin to gold ratio is apparently trading almost, quote, tick for tick with the market capitalization of Dogecoin.
Wow, Dogecoin. That certainly puts Bitcoin's current valuation into a certain perspective, doesn't it?
It certainly does. So, based on all this analysis, the newsletter puts forward a pretty strong argument. Bitcoin is primarily a vehicle for speculation, not really that stable store of wealth or reliable currency some proponents claim.
They point to the volatility, right? And they even draw a parallel to, what was it, the mutual fund bubble back in 1966.
Yeah, quite the historical comparison. And interestingly, the newsletter even posits that future central bank digital currencies, CBDCs, might actually need a gold anchor to establish credibility.
Which really underscores the enduring role gold plays in the financial system.
Absolutely. They argue gold is gaining value partly because fiat currencies are getting increasingly burdened by all this sovereign debt.
And it's worth remembering, as they point out, even the Bank for International Settlements, the BIS, recognizes gold as a Tier 1 asset, right up there with things like U.S. Treasuries.
That's a key point. The newsletter also touches on some of the, let's say, unresolved questions around Bitcoin, like the whole mystery of Satoshi Nakamoto, its creator.
And that huge untouched Bitcoin wallet. Yeah.
Exactly. And they even raise the concern that Bitcoin, far from being about financial freedom, could potentially evolve into a surveillance tool.
That's the Trojan horse idea again, in a way.
Kind of. And they draw this stark contrast between Bitcoin's, decade-and-a-half history and gold's millennia-long track record as a safeguard.
And currency collapses, volatility, centralization risks. Going back to 480 BC, they say.
That's a history Bitcoin just can't match.
Okay, so given all this analysis, what are the specific investment strategies the Macro Butler newsletter is recommending for right now?
Well, their main focus really shifts. It's less about chasing high returns, return on capital, and more about prioritizing return of capital.
So preserving what you have, given their expectation of an inflationary downturn.
Exactly. And their core recommendation: hold physical gold and silver. They see these tangible assets as the most dependable hedges against potential government and central bank actions.
Makes sense within their framework. What about cash?
For managing cash, they suggest short-dated, investment-grade USD bonds and T-bills. Keep it safe and liquid.
And companies. Any specific types they like?
Yeah, they express a preference for companies with low leverage, strong growth in earnings per share, EPS, and free cash flow, FCF, particularly in energy and commodity production sectors.
Okay, so real assets, strong fundamentals. What about things to avoid?
Notably, they advise against holding long-dated U.S. treasuries and bonds. They basically deem them uninvestable given their outlook on inflation and rates.
Got it. So what's their current market perspective as of April 11th, 2025?
Their view is that the U.S. is still technically in an inflationary boom. However, they anticipate an inflationary bust is likely to happen sooner rather than later.
And that's based on that S&P 500 to gold ratio dipping below its 7-year moving average.
That seems to be a key indicator for them, yes. So their overall advice is, stay calm, stay disciplined, use the market data, don't get swept up in hype.
And stick with physical gold as the historically proven wealth preserver during inflationary times.
Right. While they characterize Bitcoin pretty harshly as scam, a leveraged, energy-hungry tool likely to underperform gold in this kind of environment.
They also mention using the Bitcoin to gold ratio, kind of like the gold-silver ratio, as maybe a tool for investors.
Yeah, potentially helpful for making decisions about allocating between stocks and cash, or maybe adjusting your overall equity exposure based on how stretched that ratio looks.
Interesting. Tactical use.
And the final thought they really leave listeners with is that element of autonomy.
Mm.
Owning physical gold outside the centralized digital systems, it offers protection not just against currency issues, but also volatility and, well, centralization risk.
Okay, so as we wrap up this deep dive into the Macro Butler newsletter, the central message seems pretty clear. They're making a strong case for gold to outperform Bitcoin significantly in this current risk-off phase.
Yeah, they really position Bitcoin as primarily speculative, lacking those fundamental qualities of a true safe haven or store of value, especially when things get uncertain.
Which, naturally, leads to an important consideration for everyone listening. How do these arguments, this perspective, align with your own investment philosophy and your personal tolerance for risk?
Definitely something worth reflecting on. It's a very distinct viewpoint.
Absolutely. And on that note, here's maybe a final thought to ponder. Considering gold's long history and the kind of analysis we've discussed from these market ratios,
Hmm.
is the current, massive enthusiasm around Bitcoin perhaps masking a significant underlying shift back towards more tangible assets?
Hmm. What lessons can we draw from past asset bubbles when we think about the potential future for these different asset classes?
Exactly. Something to think about. Thanks for joining us for this deep dive.